Morning, everyone, and hello to one of you from wherever you are listening to us. I'm very grateful that you could create time to join us today. Hope you can hear me from whichever part of location that you are listening to us from. So welcome to the webinar today. My name is Okendo Frederick. I am in the advisory team and within the consulting space at taxation East Africa LLP. I hope you're all well and your day has started on a very, very great note. Yeah, so let me take the opportunity to thank you for joining us in this noble conversation today. The topic that we'll be covering is new tax laws affecting your organization from 2022, 2023. We all know that tax is an ever-evolving conversation. On its dynamic nature, businesses have to adjust accordingly to either comply and reduce on impending liabilities or capitalize on the relief availed when it is availed. I have never seen businesses waiting for tax penalties in order to make a profit. And so I'm pretty sure that you were very expectant, even as we collect ourselves together to listen in to the knowledge and the wisdom that our well-able panelists will be sharing with us today. Just on some housekeeping matters, let us ask our questions at the end of the presentation. We shall have a brief session for Q&A towards the end of the session. Should you want to ask a question during the presentation, I encourage you to post them on the Q&A button, and we will have responses for each and every one of them as we proceed. I also believe so far we all know how to unmute to speak. But before you do so, please raise your hand, then you will be given a chance to proceed with your question. I will therefore go straight ahead to present to you our tax team for the session. I want to just ensure that as I do so, I'm able to just share the profile. Yes. So we have a well-able team that have experience in handling tax issues, whether tax disputes, carrier correspondences that have things like tax health checks and any support along the line that you may require. So we have CPA Nimrod Kurgat and CPA Virginia Kamau. CPA Nimrod is a partner at KKCO East Africa in charge of audit and tax. He's a member of ISACA. ISACA is Information Systems Audit and Control Association. He's also a member of Institute of Certified Public Accountants, that is ISPAC, in good standing. He's a Bachelor's of Commerce graduate and has over 19 years, I should even say more than 20 as of to date, in providing full range of business advisory and audit assurance, risk management, and tax services in different sectors, both local and international. He has a vast experience in transfer pricing, working with several clients who have presence outside Kenya. He has represented several clients in tax tribunals successfully and, of course, extensively. So I'm pretty sure when he'll be making his presentation, we'll be well ready and willing to receive from that which he has prepared for us today. The second panelist that we have is CPA Virginia Kamau, who is a tax team leader at KKCO East Africa as well. She's also a member of ISPAC and Institute of Internal Auditors in good standing and a graduate of BCom accounting from Egerton University. She's currently pursuing a master's in tax and customs administration from KESRA. She has over 6 years experience in audit and tax, handling both local and international clients as well. Her experience spans different industries, including but not limited to manufacturing, professional services clients, and not-for-profit organizations. So from whichever entity you're coming from, whether it is NGO or profit-making, service-based industry, you can be sure that the value you receive is indeed well researched. She has carried out several tax health checks for clients, enabling them to make material savings in their organizations. She also has an excellent working relationship with many clients in that front to enable be able to give you living experiences. So that is about Virginia Kamau and Nibal Kulat. Along the webinar, we will be presenting to you some polls, and hopefully you will respond to each of them because they form part and parcel of the conversations that we'll be having. And for now, ladies and gentlemen, allow me to welcome CPA Virginia Kamau. Virginia, there?
Thank you. Yes, thank you, Fred. Good morning, all listeners and viewers. It's a very good morning. I'm going to welcome you to our webinar. It's a big welcome as we go through today's topic about taxes, new tax laws affecting your organization from the year 2022-2023. We are going to check on a few items as I highlight them. We are going to see, let me share with you what we need to check. We are going to see a corporate income tax, the changes that we are going to experience during the financial report for 2022 that we are about to complete the audit assignments and do the filing of the same. We are going to check on digital tax services. We are going to check on deferments of foreign exchange losses. We'll be checking on capital gain taxes and other changes that have taken into effect during the year 2022-2023. More so talk of NSSF, we have the NITA, we have the VAT that comes with teams. Then finally, I'll hand over to our partner in tax to bring on common tax exposures. As we continue logging in, we'll go straight to our first topic of the webinar. This is about the restriction, the interest restriction, the EBITDA restriction. We are going to see financial year 2022. We are going to incorporate the new changes that came about with the Finance Act Bill 2022. It brings about the restriction of interest to a 30% of earning before interest, depreciation tax, and amortization, whereby organizations are therefore required to restrict the excess of the 30% and disallow that amount. And for cases where organizations they have not met the regulations, meaning that the interest is lower than the 30%, they are going to be allowed on the deducting the interest expense. So as we continue to conclude our audits, this comes to our accountants and finance manager. We need to take effect to that and remind ourselves about that to avoid future investigation or issues to arise later with KRA. About this EBITDA restriction, it is excluded. We have those organizations that are excluded from these restrictions. We have those organizations that banks, financial institutions, they are they're exempted from this restriction. We also have those SME, small and medium enterprises that are registered under the SME Act 2012. They are also are exempted from this restriction. The other thing about this is that we have a question for us here in regards to this restriction that was issued out in the Finance Act v 2022. And the question goes, how has the EBITDA restriction affected your business? How has EBITDA restriction affected your business? This is a poll question that we expect our viewers and our listeners to come in and answer, give us a response to this. How about how the EBITDA restriction are affecting our businesses? So this is a question we need to get an answer from us, from you viewers. Yes. As we continue to check on that poll from our IT, we are going. Is it clear, Joe, Fred? Joe? Yeah, the question. Yeah. The question that we have posted there, how is the EBITDA restriction affecting your business? We'll skip that until we skip that poll. As we get our IT guy to sort out this. It's ready. Yeah. We're expecting some answers from you as how we are going, how the EBITDA is going to affect your business. And we can see your answers to that. Thank you. This restriction, we are going straight to the answers. This restriction is going to affect our business in the manner that we are going to restrict our borrowings. It is going to restrict our borrowings, and again, it is going to affect our tax savings. And again, it is going to restrict the foreign exchange losses. Yeah, this restriction is going to affect us in 3 ways, whereby we are going to be restricted from borrowings. We are going to be restricted also in foreign exchange losses. And again, it will affect our tax planning. So on this point, we are going to let you know that we are there for you for any form of tax planning that you might need. We are there for you at KKCU for such tax planning. The other item you're going to check is the deferment of foreign exchange losses. This came into effect from 1st of January 2022. And again, it was brought about by the Finance Act Bill 2022, whereby this also is depending on the restriction of the EBITDA that we have just seen or talked about earlier. So once you are restricted from the EBITDA deduction, the interest rate, again, you are going to be restricted from claiming the foreign exchange losses. So this one also depends on the restriction rate. If you are not restricted, you are going to claim the foreign exchange rate. If you are restricted with that rule, the 30% rule, you are not going to claim the foreign exchange losses. This also comes as a negative part of it to our business. Another change that we are going to experience in this financial year 2022 is about digital service tax. We all know that this is about trading of, or rather, those people who do business in the digital marketplace. This change came from the Finance Act Bill 2020, sorry, where we had a digital service tax being experienced by residents, both the residents and non-residents. Come financial year 2021, it changed to only to non-residents. And now financial year 2022, it is still talks about DST being imposed on the non-residents, whereby they are expected to have the DST at the rate of 1.5%, which is payable on or before 20th of the following month. And this rate is at 1.5 on the gross transaction value. It is on the gross amount. This one already has taken into effect by start of January 2022. So we need to also to incorporate that. The other changes that came into that was brought about by Finance Act Bill is about the capital gain tax. We have the capital gain tax that increased from 5% to 15% on sale of or gain on sale of property, whereby we all know the sale of property could be either land or sale of shares, and these shares should not be listed in the Nairobi Stock Exchange. So we are supposed to have capital gain tax at the rate of 15%, and this capital gain tax is payable on or before 20th of that month when the transaction happened. And just a reminder on this one is that remember, once you submit your returns to KRA and you've already made a sale of a property, remember KRA is in a position to check and see you made a transaction, and therefore it's a reminder for us to be sincere and do the capital gain tax, because they're also going to get the information from other parties that you made a sale. So it's just a reminder that we need to do the capital gain tax at the rate of 15% that came into effect from January 2023. The other changes that we need to remember to effect is about the donation. The donation, we know from the previous finance bill, it was restricted to cash donations, but come to 2022 Finance Act bill, it was revised to any donation that is given out to charitable organization whose income is exempted from tax under the paragraph 10 of the first schedule. We all know that non-profit organization or government institutions that have exempt, they have to go under, they have to apply for exemption through the regulations that are set out in paragraph 10. So for our organization, that a charitable organization that is tax exempt and you've made your donation to that organization, you are entitled to allow that expense, the donation expense. But we have a clarification to make. It's allowable only that only if you made the donation to an exempt organization. So by that, it means we need to get a certificate of exemption from those organizations, maybe for us to have proper records in case we need to disallow that expense. The other thing that is going to, that changed with the Finance Act bill is the is about introduction of withholding taxes. We have withholding taxes that came about. For example, we have on withholding taxes that came on the financial derivatives that we are that is yet to that came in, and it is came with the effect from 1st of this year, 1st of January this year. Again, there was a review of withholding tax on. There was a review of withholding tax on interest and deemed interests on bearer of bonds, which are at least 2 years, with a duration of at least 2 years. It was reviewed down from 15% to 7.5%. We have also exemption on dividends to entities that are trading in the special economic zone. This also came into effect from 1st of July 2022. Also, we have exemption on payments that are made to non-resident by human vaccine manufacturers. Also, this came into effect from 1st of July 2022. These are the changes that came about with withholding tax. We're also going to talk about the VAT. There are changes that came in the VAT Act. We have recent changes on exported services, which were previously exempted, but now more exempted. But the exemption moved from the exempt rate to a standard rate. And again, there was an introduction of exportation of taxable services, that is the BPO. It was rescheduled to zero-rated rate of VAT. We also have a change in VAT on LPG gases that reduced from 16% to 8%. That is a good reduction. Then we have fertilizers and farm inputs, or inputs on raw materials that manufactures fertilizers. It was reduced to, it was brought to zero-rated. Again, we have inputs that we have a change on inputs that was reviewed up to 6 months upon the amendment of the VAT return. We know that there have been challenges in the VAT, more so when you want to file your amended return. The system, or most of the cases, it used to restrict you, and following the High Court ruling in one of the case that was filed by one of the construction company, Gracon Construction Company, the court had a ruling that the input is only deductible within 6 months from the supply, or when the supply occurred. So it's a good sign that we are able to claim VAT inputs, or we are able to amend our inputs regardless of during the period that you're filing in. There are also changes in VAT, things to do with introduction of refunds on credits. We have refund on credits, whereby it was reviewed in a way that taxpayers are able to claim refunds on taxes that were made erroneously. or on credits, on continuous credits, on withholding items, like for example, when an organization or an entity that is subjected to VAT standard rates does a supply to an organization that with zero rated goods, and the other organization have done the withholding, you are entitled to claim that withholding and you apply for a refund. But following the recent change from the president that suspended the issue to do with refunds, we are yet to get a directive on how to go about that. But it's a good sign that we are able to withhold to claim refunds for VAT that is done for any amount that is done erroneously, more so in withholding that was done to a wrong PIN. We are able to claim for refunds. Another issue we are going to check on is about the changes in the NSSF. We all know that following the court appeal that was issued on 3rd of February 2022, it came to change the NSSF rates, whereby the employer and the employees are required to have deduction towards or savings towards the NSSF at the rate of 12%. That is 6% from the employer and 6% from the employee. With this change, we have lower limits and we have the upper limits, whereby in the lower limits we have a tier 1, and come to upper limits we have a tier 2. In this case, in tier 1, this is a compulsory contribution. Every employer is entitled to this compulsory contribution. When an amount goes up to a higher limit of 18,000, we get into tier 2, whereby an employee is deducted 6% of that amount, and by that you get into both tiers, tier 1 and tier 2. But remember, this is not the tier 1, which is the 360, is not stationed. We are going to see it will vary from amount to amount. Supposing someone is having a 10,000 basic pay, you'll only compute 6% of that, so it will vary depending on the amount. But basically, we know it's a 6% for employee and 6% for the employers. But again, this came into effect from 9th of March 2023, and we are expecting that we already took into effect of this. But then again, good news is that there are possibility of employers opting out from tier 2, and this can only be done through application or to the RBA, the Retirement Benefits Authority, through filling in a form called C1, whereby you request for the RBA to exempt you from the tier 2. And once you are granted the permission or the exemption, you are good to go. You no longer need to comply with tier 2. But before then, we are all reminded to comply with both tiers. Those are the changes that came about with NSSF. Up to this juncture, I want to introduce our partner in tax to take us through the next session about the changes in the Finance Act Bill 2021, and also he'll take us through the common tax exposures and emerging trends. Welcome, Mr. Nimrod, for the next presentation.
Thank you, Virginia, for the presentation. Allow me to share my screen. Yeah, so I'm not sure whether you can see my screen. Okay. So we are picking on some of the changes as a result of the Finance Act 2021, and which are mainly effective from financial year 2022 or mid 2021. Which we believe the impacts or the application or it will be applied in the year 2022. I know most of us, their year end is 31st December, and you are currently finalizing on the 2022 financial statements. So in the Finance Act 2021 changed the capital allowances in terms of how you compute capital allowances. The rates, previously we were using what we normally call the reducing balance method. So that changed. So effective 1st January 2022, capital allowances wear and tear, they are all on a reducing on straight line method. So please, as you do your tax computation for the year 2022, ensure that you use straight line. On the definition of the digital marketplace, of course, this was not there initially. So this was introduced mainly to define what a digital marketplace is in respect with taxation of the digital service taxes. You will all remember the tax losses. Initially, it was limited for a period of 5 years, that it was extended to 10 years. Then Kerry introduced the concept of corporate minimum tax. As you are aware, taxpayer went to court. They won the case. CMT or corporate minimum tax was said to be unconstitutional. Kerry appealed, and in I think it was 2nd December 2022. Kerry also lost. So we are yet to see whether they will pursue the case further. But during the introduction of corporate minimum tax, the limitation of carry forward of tax losses was repealed, so that taxpayers can now carry their tax losses perpetually. We are not sure. We suspect since they lost the case on corporate minimum tax, they may now revert back to restriction or limitation of the carry forward tax losses. Then tax rebates on provision of apprenticeship. I think this is mainly for institutions or organizations taking up students from both technical or even higher learning institutions. Previously, it only covered the university students. So effective 1st July 2021, you can now claim a tax rebate if you can prove that you've hired students from technical and vocational education training, that's TFET, for a minimum of 6 months. But I think the key word is should be not less than 10 students for you to benefit from this tax relief. The other item is I'm sure all of us we are compliant with the electronic tax invoice regulation rules. The deadline for compliance was end of November. So I believe all of us, as long as you are registered for VAT, you have a VAT obligation. You are required to have Teams or electronic tax invoice, which is compliant. And I believe all of us are still compliant with this provision. And I believe we can be sharing in our chat or question Q&A. You can be sharing your experiences, your challenges in implementation of the teams. Recently, or over the last 2-3 years, some of the key strategies KRA are using is the move toward desktop audits, where they do a lot of data analysis, mainly using iTax. And some of the common queries or questions we receive from our clients is about the inconsistencies, especially on the payroll inconsistency. So they compare what you filed in your tax return versus what you filed in your pay-as-you-earn return, and compare the two. Ideally, it should agree. So we recommend that this employment costs reconciliation or payroll reconciliation should be done on a monthly basis before when you're filing your PAYE returns. You can introduce a control, ensure you compare the two so that there are no inconsistencies. Employee versus consultant is also a common practice, a common issue among taxpayers, especially with the concept of remote working, where employers hire remote workers. Are they consultants? Are they employees? It's a big thing, and I think we recommend you assess your position. I think the key word which you normally need to test is control. The nature of control over that employee or a consultant. But of course, we recommend if you have similar cases, please, you can get in touch with us so that we can analyze the facts and give a recommendation on whether you treat it as employee or a consultant. The other issue is on the VAT inconsistencies. which is similar to the salaries inconsistency, where they compare what you declared as sales in your tax return versus what you declared as sales in VAT returns. So we also recommend monthly reconciliation before you approve or you sign or you file your monthly VAT returns. Do a reconciliation and document, save it somewhere, so that you don't face these inconsistencies challenges in future. But of course, the VA is over the last from 2018-19, the VAT auto assessment was one of the key tool KRA was using, which was mainly suspended because of the introduction of the new ETR, the teams. Because with the teams, you are not in control of your input VAT. You only claim what is in their system. So VA was suspended, but we believe with the teams or the new ETR, most of these inconsistencies will not be there. Of course, areas which exposes taxpayers is I've mentioned the VAT inconsistencies, POI or salaries inconsistencies, and of course VAT refunds is also another area, because when you file for a refund, you are automatically inviting the taxman to do an audit. And the sad thing is, I think KRA to refund taxes is, I think it's very difficult, and sometimes we normally say it's better to either underpay than to overpay, because even the cost of securing that VAT refund can be higher than even the penalties or interest as a result of underpaying. Third-party information, especially the withholding taxes, which are in your tax iTax, but you fail to declare when you're filing a tax return. Those are the common areas of exposures. The other recent public announcement by KRA, which most likely will affect the small traders who normally import, and they have agents who normally do what we call consolidation. This was just a communication from KRA, and this will affect those people who consolidate items and ship into the country. So KRA, they want to change the method of assessment of VAT, excise duty, the IDL and RDL. Of course, this is aimed at increasing tax revenues, but of course, it will affect the cost of those imported items, and also the cost of doing business for most of these small traders who are not able to import in bulk, but they import in consolidated amounts. Then in terms of tax planning opportunities, of course, tax planning should be within the law, within the provisions of the law, and we normally tell our clients tax compliance is one of best strategy of tax planning. Ensure that returns filed on time, payment of taxes on time. For the December plan, 31st December year-end organization, kindly note the installment tax for 2023 is due next month, 20th. Tax balances for the year 2022 is due on 30th April, and tax return for the year 2022 is due on 30th June 2023. So filing taxes on time, payment on time is the best tax planning advice. When dealing with carry audits, queries, and any matters, reconciliation, and all those, it's always better if you engage tax consultants so that they can see how to respond, how to utilize the available tax laws to benefit the taxpayer. Regular audits, tax health check should be a must within a period of 3, not more than 4 years. Ensure you conduct regular tax audits so that you are aware and you are in control of your taxes, and you avoid surprises when the taxman comes. We've talked of reconciliation on a monthly basis, then training of your employees on tax matters is critical because these are the people who are handling these transactions on a daily basis, so that they're able to address any non-compliance before a decision or a transaction is done. The Income Tax Act, we have several allowable deductions and tax exemptions, which it's good to familiarize yourself, or you can seek an advice from a consultant on what are some of the incentives which are there, which are available, and which you can utilize. And before you make any business decision or sign a contract, agree on a deal, it's good to assess the tax implication, so that you so that when you're making a decision, you know the overall impact, tax impact on that business decision. For those doing cross-border businesses, DTS tax treaties with various countries, it's beneficial to set up or to have your head office or your related parties in a country where Kenya has tax treaty, because you are shielded from double taxation, and when it comes to withholding tax, corporate tax, the personal taxes, there's a lot of benefit in doing business with a country where Kenya as a ratified DTA. So basically, that's a quick summary of some of the tax laws taking effect from 1st January 2022, which I believe you've seen, you've felt the impact, especially on the one on interest restriction. We've received a lot of comments from our clients because it's like telling them not to borrow. Yeah. So the borrowing is previously borrowing was one of tax reduction strategy, and with this interest restriction, it will really be difficult to benefit from interest expenses. I can hand over to our coordinator, Fred, for the Q&A session. Thank you.
Thanks, Nimrod and Virginia for such an extensive presentation. Yeah, I see a number of delegates managing to sharing the questions in the chat, and I'm hoping that there is the responses you're receiving from our team meet your expectation. But should you feel that you still need much more detail, please feel free to raise your hand, give you a chance, and you'll be able to say and proceed with what it is that you have as a thought. But thank you so much, Timothy and Virginia. So I think this is a session where we say the floor is open for us to ask our questions.
Yeah, so I think we can have a quick session on Q&A. Bernard, you've raised your hand. Bernard Kirui, please, you can.
Thank you, Fred. I wanted to ask a question. I think I've posted in the chat, and it's more on the compensation of a software, whereby in a scenario where you amortize the software up to a point where the total amortization cost is equals now to the cost of the software. What happens in such a scenario, and maybe you are still using the software within your organization? Thank you.
Okay, thank you, Bernard. I'm not sure whether that's a tax question or an accounting question, because for accounting question, if you are still using the software, of course, the standard allows you to revalue your asset, so that you because it still has a useful value. But for tax purposes, you know, the computation of wear and tear allowances on software, it's mainly once you've claimed everything. I think that there's you can't revalue and start claiming wear and tear allowance on softwares. Once you've exhausted, there's no room for revaluation. But for accounting purposes, yes, you can revalue. but for tax purposes, it's not possible. I don't know whether that was your question. That was what you're asking. Okay. Wycliffe.
Yeah, so mine is just to request more clarification on VAT for export of services to organizations that are not Kenyan. So in this case, what I want to know is, was it changed from exempt to standard rate if it's consultancy services that are exported to external organizations? And this was in the Finance Act 2022. Was it effective from 1st of July 2022, or what are the dates of its effect? Yeah.
Yeah, thank you, Wycliffe. That's one of the key. It's one of the law which has really affected most of companies, especially doing business in Kenya, and they were doing business with an external related company. Yes, it was previously the Finance Act 2020 removed export services from 0 rate to exempt. Yeah, then come 2022, it was now moved from exempt to standard rate. So that's the current. That was effective 1st July 2022. You may be aware, there was a court case. Somebody went to court to challenge the taxation of imposing of VAT on export services, and the courts ruled in favor of KRA. They said that tax provision is constitutional. So basically, that's the current status. Export services are affordable under the standard rate, which is 16%. But what was introduced in the same act, Finance Act 2022, was what they call business process outsourcing or outsourcing services. We were not given definition of what is business process outsourcing, which we believe in the next upcoming Finance Act 2023, which will be out next month, will seek to clarify what qualifies under business process outsourcing. Yeah, so for now, export services, I know they are punitive. Yeah, but that's a current tax loss or treatment.
Okay, thank you.
Okay. Anyone with any other questions? Our time is almost ending.
Yes, I have a question.
This is who?
Moses.
Moses. Yes, Moses.
Yes, I just wanted to be guided on the difference between e-teams and teams. I understand that now there is something going around called e-teams. Yeah.
Yeah, there's something going on called e-teams. Yeah, and I think, technology keeps on changing. I don't know whether the taxman was aware of achieving the same results without telling taxpayers to purchase devices, because eTIMS it's an electronic ETR, which you don't need to buy any device. I know most of us were forced to acquire expensive small devices, but it has now emerged that you can have an electronic ETR, a software, which you can run, or it can sign your invoices. Kerry is currently doing a pilot on a few taxpayers, and we believe they'll be communicating their feedback. Most likely they'll be rolling that e-register anytime soon. The only challenge is what of the cost we've just incurred in acquiring these devices. Yeah, so we'll update you once the e-register is rolled out. Thank you, Moses. Yes, Alan.
Yes, I have a question with regards to VAT. Assuming I'm offering vertable services to an NGO, which has been approved as a VAT exempt, how should I treat on the eTIMS, like issuing VTR, and how should I be filing it on the iTax portal?
This was Joseph, Alan, sorry. So you're saying you're dealing with VAT exempt organization?
Yeah, we have VAT obligation. We have a VAT obligation.
But you are billing a VAT exempt?
Yes.
Is it the service is exempt or not exempt?
Vertable. It's vertable.
Or the service is vertable.
Offering legal services to an NGO.
Okay. Yeah, maybe we've of course previously under the old system you're supposed to have a certificate, but with these new teams, maybe you can allow us to check. I've not experienced that specific case, but allow me to check with my technical team on how they handle through Teams.
Okay.
Yeah. So we'll drop you an email shortly after this webinar.
Okay. Thank you.
Yeah.
I can see Joseph as Richardson, Jumpy as well. You want Joseph? You can take it up. You can proceed with your question.
Thank you, Mr. Colbert. I have this question for you. I'm a software developer, and most of my services are consumed by clients overseas. So I've heard you mention that we need to pay or to charge VAT on the services that we offer this overseas client. Maybe you can clarify that for me if that also affects my case. And I would also be interested to know if you offer such services to independent software developers like me. Thank you.
Thank you. Yeah. Thank you, Joseph. Yes, we hear you. It's really making the cost of doing business in Kenya very expensive. because even companies or foreign companies who had planned to set up businesses in Kenya they may be forced to move to other countries. So even doing business outside Kenya or having clients outside Kenya, the 16% is I agree with you, it's punitive, and it affects, because software is one of the portable service. It's not in first or even the second schedule. So Joseph, yes, you are affected by that provision where export services were removed from the exempt category or even the zero rated category. But we are aware of lobbies by various professional institutions, including ISPAC, on the need to either to zero rate export services. So please, when I'm sure we will be making strong submission when the finance bill will be out, and we expect something will change. Either they will include under the definition of outsourced services, or they can bring back either zero rating or exempting export services, including even softwares. Yes, Joseph, we have a tax team who should be able to support you in your various taxes, especially if you are doing business with non-resident companies. I'm not sure whether there's a relation with the non-Kenyan company, because you also need to assess whether you're exposed to the transfer pricing rules, which I believe our team will get in touch with you shortly after this, so that to see how you can be supported. So I think because of time, we can take one last
There's one last question we have from Katiwi Njabi. I see also Samuel Mumbere has one last one possibly. So maybe let's take from Jambi and then last person Samuel. For those who have further questions, we can provide a channel of how they can send that through for an offline response. So Njabi, take it up.
Good. Thank you very much and good morning. Thank you, Bwana Nimrod, and your team for the presentation. We are wiser. There were quite a number of questions put on the chat. Maybe someone could have taken time to go through them, but that's okay. The responses can come later. I had two questions. One is I recently saw a post that KRA was withdrawing all exemption income tax exemption certificates. So maybe you could just speak into it, whether it was, it was legit, or someone who, is, yeah, just say something about it. And then the other one was on the tax requirements for a context where an employee employed by a Kenyan firm and paid, in terms of salary by a Kenyan firm, has been sent to work in a country that is out there. What are the tax requirements? Yeah. Thank you.
Thank you, Jambi, for the question. The first question about the exemption. Yes, following the recent directives from the president about the holding on of the exemptions and waivers. Currently, if you have the exemption, it's not that you are going to be withdrawn the exemption certificate. It's only that the process from now on, any exemption application is put under hold, but it will be done under vetting. It will be put under vetting, whereby not all those who really qualify for exemption will be given. I mean, not everyone will be given an exemption, but they'll be put under vetting for those who qualify for the exemption. But in case you have a current one, it's still valid until otherwise stated. About the other question about Kenyan employee, maybe you can raise it up. I didn't get it well, kindly.
It was a request for your advice on a Kenyan
Yes,
company. A Kenyan company sends a Kenyan, one of their employees who is Kenyan, to work in a country that is outside of Kenya for maybe a period of about 3 years. Yes. Sorry, you can't hear me? Can you hear me? Okay.
Yes, we can hear you, Jambi.
Oh, okay. Sorry, I thought I couldn't be heard. Yeah, so I was talking of a Kenyan company that has sent one of their employees, who is a Kenyan, to go and work in a country outside of Kenya for a period of time, say 3 to 5 years or so. What are the tax requirements?
Any other question? We didn't the second question from Jambi.
And Jambi speaking, she's ongoing with her question. Jambi, proceed.
Okay, let me just ask it again. So we have a Kenyan company that has a Kenyan employee who is sent to work outside of the country. What are the tax requirements? Do you continue to deduct payee? And will they be charged tax in this country and then in the country where they have been sent? Yes.
Oh, yeah. So Kenya will have the taxing right because of the Kenyan company is the one employing. They're the ones paying the taxes. The only maybe if that other country, if Kenya has a DTA, then you should be able to recover that tax paid. But as it is, yes, there will be an issue of double taxation. Especially, I'm sure if this person is a Kenyan resident, persons are taxed on their worldwide income. So long as you have a permanent establishment in Kenya, you are a tax resident. Even if you step in Kenya for one day, you're liable to pay tax in Kenya. We can move to the last question, then we conclude the session.
Hello, can you hear me?
Yes, we can hear you.
Yeah, this is Samuel. I wanted to ask about the issue of VAT. It could be that my knowledge is a bit limited, but I thought VAT was a periodic tax in that you're supposed to file by the month. So I was asking, how do you file? Because the law allows you to utilize input tax up to 6 months later. So how will an invoice which relates to, say, 6 months previously be filed in a later period, considering it's dated an earlier period, and we know the iTax is likely to reject such? Thank you.
Thank you, Samuel. I don't know whether I understood. So you're saying Yes, VAT is it's you need to pay to file returns on a monthly basis. Yes, it's true. Input VAT, it has to be within a period of 6 months. After 6 months, it will be time barred. You're not allowed to claim, and most likely iTax will reject unless you manipulate the dates. But with teams, with the new ETR, you'll not be keying in anything. What the other person has declared on the other side will automatically appear when you're filing your returns. So you'll only claim input VAT, which is already in your iTax account. So the issue of even time limitation and all those will not arise. So I'm not sure whether I understood your question and whether I've answered your question. Maybe you can chip in.
Yeah, I would say it's partially answered. Okay, let me ask it in some other way.
Yes.
For example, before the 6 months ends, say this month I'm filing for the month of February.
February, yeah.
Yeah, but then I have an invoice which relates to November last year.
So November, December, January, February. So you're still within 6 months.
So I'm still within 6 months.
Yeah.
How will I file that invoice, considering the iTax will only take in invoices relating to...
It will accept. It will accept since it's within 6 months.
Oh, okay.
Yeah. So if it was for May last year, then automatically that one will not. Your time barred. So you can claim, because we are currently doing for February.
Yes.
Yeah. So you can claim February invoices, January, December, November, and October. October and even August. No, September, sorry. So you can still claim, you can go back 6 months.
Oh, okay. So iTax will not limit me at the...
No, it will not. No, it will not. You are not limited to the February, because there are many reasons. Most likely you've not received the invoice from the supplier. So they understand that there are those challenges. Yeah, so 6 months, you move 6 months backward, you can still claim your input VAT.
Oh, so thank you very much. Adequately answered.
Okay. So thank you so much, members, for finding time. We had purpose to clear this presentation within 1 hour. And we believe we've added value to your businesses, and there'll be improved compliance in terms of you're not penalized for not doing the right thing. So for the questions and the Q&A, we will respond. We'll get back to you before. You can give us up to tomorrow, latest, to respond directly to all the questions and the Q&A. So from our side, we want to thank you so much for joining us, and of course, we will be having another webinar when the Finance Bill 2023, the Finance Act 2023 is out, to share and see how we can enhance compliances and tax savings. Thank you so much, and have a blessed day. Unless Fred, you have anything to add?
Not at all. I just want to say thank you to everyone for joining us, and yeah. we'll have another session. Maybe the guys you can respond to the poll that is on your screen, or just how just a rating of how the webinar went, and you are free to exit at your own pleasure. Thank you so much, everyone.